Salutations, this is Brian Jarris from Ville Wealth Management. In today's video, we're going to talk about the Opportunity Valley and how to avoid large tax bills in retirement. Now, Ville Wealth videos are meant to be educational only, so if you need customized advice tailored for your situation, please reach out to us at villewealth.com. Let's briefly talk about what do I mean by the Opportunity Valley. So as we approach retirement, most of us, our paychecks are ending and there's a pretty big drop in our income to the following year. Now, some of you may be filling that gap with taking Social Security earlier than later. Then once we get to about age 73, that's when required minimum distributions start kicking in. So the Opportunity Valley is really when the paycheck ends and when the required minimum distributions start. If you want to deepen that valley even more, you can delay Social Security. And that's going to provide us an opportunity that we're going to now talk about. Let's talk about the future tax problem for those with larger retirement accounts. So if you're over the age of 50 and have successfully built up substantial retirement accounts, you're probably going to face some serious tax issues in retirement. Now, over the last 30 years, federal tax rates have been at an all-time low and will probably continue through 2028. The federal deficit is now at an all-time high, so we're probably soon going to see higher tax rates in order to ease that tax burden. Once we reach age 73, which is the required minimum distribution age, for a lot of us with larger retirement accounts, those RMDs are going to force you into the highest tax rates probably for the rest of your life. In addition, you'll face IRMA, which is the income-related monthly adjustment amount, which will impact your Medicare Part B and D premiums and push those into the highest rates, complicating your retirement even further. The Secure Act 2.0 has changed how your heirs can access your retirement accounts at your passing. They can no longer stretch distributions out over their lifetime. They're now required to take all the money out within a 10-year period of your passing. So if you've accumulated over $2 million in retirement accounts, that means your heirs will be in a significant tax burden where at least $200,000 in annual withdrawals will be coming out over that 10-year period, probably pushing them into those higher tax brackets. Now, the average age for retirement for men is around 65, for women is around 63. If they delay retirement, Social Security, until age 67 or full retirement age, that creates that Opportunity Valley that I'm talking about, where you have a period of time with lower tax rates. By utilizing some strategies during this time, you can lower your future required minimum distributions as well as your overall tax rates. So some of the common strategies would be to take advantage of Roth conversions or just take direct withdrawals during this period of time. What that does is fill up your lower tax brackets, take advantage of that, as well as what we call filling up that Opportunity Valley. And the end effect really is you'll pay a lot lower taxes over your lifetime. Many future retirees may face a tax tsunami when they get into their retirement years. There's a list of additional taxes that can apply if your income is higher. Let's go through a few of these. We talked about how larger retirement accounts will equate to larger required minimum distributions, potentially pushing you into higher marginal rates. Then there's also capital gains rates. As your income rises, it can push you into the 15 or 20% capital gains rate. Your Social Security can be taxed at higher percentages. You get over a certain amount, it's 50%, and at the highest rate, 85% of the Social Security can be taxable. There's also a 3.8% Medicare surtax if your net investment income or modified adjusted gross income is over $250,000. Lastly, there's the Medicare premiums B and D that get taxed through IRMA, the income-related monthly adjustment amount, and those can go to the highest levels. So what are some potential solutions? Kind of two main themes here. One would be take advantage of that Opportunity Valley, populating those lower tax brackets with Roth conversions or pulling direct withdrawals from your retirement accounts. That's going to lower your overall tax situation throughout your lifetime. And then there's kind of what we call tax diversification. Don't have all of your eggs in one basket in tax-deferred retirement accounts. Get more money into your tax-free and your taxable accounts. That way, if tax rates do rise, you have other options and places to pull from. So how do you get more money into your tax-free buckets? You can take advantage of doing Roth IRA contributions, spousal Roth IRA, backdoor Roth, spousal backdoor Roth IRA. There's Roth 401k potential, cash value life insurance, health savings accounts. And for some, if your 401k allows for after-tax contributions, you can do the mega backdoor Roth contributions. Lastly, let's go over a sample illustration. So let's say we have John, age 55, and we got Mary, age 52. Let's assume they have over $3 million in tax-deferred retirement accounts, and they're going to delay Social Security as long as possible. So they're going to take advantage of that Opportunity Valley timeline, and they're going to do Roth conversions to fill up those lower tax brackets. Now, in this illustration, the end result was that John and Mary got an additional $6.8 million in ending assets, and they saved over $1.4 million in taxes. Now, doing Roth conversions may not be for everybody, so maybe you do a compromise strategy, some Roth conversions, and you just do some direct withdrawals from your retirement accounts to fill up those lower tax brackets. Talk to your advisor, talk to your planner, see what's best for you. Thanks for watching today's video. This is Brian Jarris from Vil Wealth Management. If you want to get a hold of us, you can reach us at vilwealth.com. Thank you and have a great week.